Hello everybody, welcome to the Leeb.com video for April 28th, 2011. Be sure to visit Leeb.com, Leeb.com to sign up for our free daily emails and to download a free special report. With the Federal Reserve not changing its monetary policy, it's clear that the sluggish economy and rock-bottom interest rates, plus of course the soaring debt and deficit situation, will continue to put downward pressure on the U.S. dollar. While the Fed is unlikely to significantly tighten monetary policy anytime soon, most other central banks around the world have raised interest rates to combat inflation. And higher inflation seems to be on the way here in the U.S. as well, even though Bernanke says that he expects higher prices to be only temporary. However, the Fed has raised its inflation forecast at this week's meeting. It now projects inflation to come in somewhere in the range of 2.1% to 2.8% during this year, up significantly from the prediction it made just 3 months ago. In January, the Fed called for inflation to be in the range of 1.3% to 1.7%. The central bank also downgraded its projected growth for the U.S. economy to fall somewhere between 3.1% to 3.3%. More evidence that growth may be slowing while inflation is on the rise showed up today. The U.S. economy grew at a 1.8% annual rate in the first quarter of this year, the Commerce Department said, well below the 3.1 pace of the previous quarter. Higher commodity prices, bad winter weather, and weak housing market, delayed construction, and reduced government spending were some of the reasons cited. At the start of the year, some economic projections call for as high as 4% growth in the first quarter and the entire year. Easy monetary policy, a weak dollar, and raising inflation, as before, send a positive message to investors despite the soft economy. Stocks are still attractive, so are non-dollar assets, notably gold and other commodities. That's it for today. Thank you for watching and join us again soon.